So I'm going to talk about a bunch of different stuff today. It's that time of year where we're looking at our decisions to choose crop insurance. Hopefully, most of our producers have made those initial contacts and started looking at the sign up for crop insurance. But I do want to kind of just give a quick over of that. And then we also have ARC and PLC sign up March 15th deadline. So make sure that you get with your FSA offices to end up making those elections, because again, it is the choice between zero and something potentially higher than zero. I don't see a lot of money coming out of those programs this year just because of where reference prices are, but again, it's something important to sign up the base acres for your individual farm. And then I want to spend most of my time talking about old crop and new crop prices. There's some very big differences between what's going on in those two markets. So we do want to end up having an idea of what's going on. First thing, just in terms of crop insurance, this shows kind of the historic corn and soybean crop insurance prices going all the way back to 2011. So the projected price is that spring price that's determined. And the key takeaway on both corn and soybeans is that we're just in a much lower price environment in terms of our revenue guarantee. So if you look back in 2022 and 2023, we were 590, 591. For 2024, we're 466. So again, that's going to affect where our revenue guarantees are for our individual farms. Soybeans, very similar thing, 1433 and 1376 in 2022 and 2023. This year, we're going to be $2.30 or $2.25 below that at 1155. And so when we think about this, we hope for crop insurance sake that we do not have to end up filing a claim and getting an indemnity paid. We hope that market forces do end up providing us with the revenue needed to be profitable in 2024. But we do need to end up recognize that our safety net is going to be substantially lower this year compared to where we have been in the last two. And so again, get with that crop insurance agent as a producer and make sure that you're getting the most out of your coverage. I encourage people to talk about unit structure, talk about buy-up coverage levels, and then some of these companion or area policies such as SCO and ECO to make sure that you're getting the most out of those products. And so when we end up looking at this, I think it's one of those ones where we really have to start sharpening our pencils and see where our protection levels are and see if we want to augment crop insurance with some other marketing and risk management tools to make sure that we're getting the appropriate in-season protection. One thing that I always do like to point out, if we do go with just our traditional revenue protection policy, one of the key things is that harvest versus projected price. So the spring price is the projected, the harvest is the one set in the fall. I'm a huge proponent of maintaining that second roll of the dice when we look at crop insurance selection, just because when we look at time periods like 2012, for example, that's a substantial increase in that base revenue protection when we see a movement in prices. So again, when we look at this chart, what it's showing is the harvest, so the fall price minus the spring price. And again, there's years where that doesn't come into effect, but the years that it typically does, you typically get a pretty good benefit from that in terms of increasing your bottom up. And so again, I encourage you to have those conversations and make sure that it makes sense for individual operations in terms of how you want to structure your crop insurance. The other program that we need to end up signing up for is ARC and PLC. I'm sure by now everybody's heard that the Farm Bill has been extended until September 30th. It's very unlikely that we're going to get another Farm Bill in 2024. I just don't think that the environment politically is there. So that's going to create some challenges. The reference prices or the effective reference prices for PLC has been modified just with the existing mechanism in the 2018 Farm Bill. So we do have a little bit of a different set of circumstances as we approach sign up. The only one that I think that may come into play is this 401 effective reference price in corn. That could potentially be in play for the 2024 crop year. It's really challenging electing these programs because we're really looking at a set of circumstances where we're projecting this a full year in advance, right? We haven't even planted this crop and we're already trying to end up commenting on where prices are going. But when we look in general, just a couple of kind of, I guess, overall general pieces of advice when we're doing ARC County and PLC sign up. The first one is, are you purchasing SCO? If you are, those base acres do have to be in PLC. There's a low likelihood of payments for both ARC and PLC, but again, it's not a cost to you. It's just taking the time to sign up the base acres on each individual farm. PLC, if you're worried about even further price declines from where we are right now, PLC provides deeper coverage. ARC is a little bit shallower. So if you're formulating a price expectation and you think that we're going to have dramatic price declines, and the example that I've been using this winter has been, if you're concerned with geopolitical tensions with China causing a catastrophic drop in prices, you may want to end up considering PLC because it provides deeper protection. If you're just worried about prices moving kind of flat to slightly lower, then probably Arc County is probably going to be the one that's going to end up being better for you, just because when we're looking at this, it provides that shallow loss that can end up being beneficial. When we look at Arc County, it also has the added benefit of having that yield component, but the payments, if we do get dramatic price declines, are going to be smaller than PLC. And so when we think about it, you know, soybeans to me looks more beneficial to Arc County unless you're purchasing SCO. Corn gets really close between PLC and Arc County, but I'd probably lean towards Arc County at this point as well. Wheat, I think, you know, where prices are right now, it's pretty close as well. So again, we have to be cognizant that we're probably not going to get big payments out of this, but it depends on where you see prices going as to which one's going to be more beneficial. Just quick supply and demand update, because this is really what's driving old crop prices right now. There's some big differences between corn and soybeans that we do have to end up taking into consideration. And a lot of that is driven by when production ends up occurring. And so this bottom chart in the right-hand corner, when we look at Brazil, for example, that second crop is planted in December, January. And so the second crop corn is going to be the one that's going to be competing with our exports in the fall. That's different than soybeans by a fair amount. One of the big takeaways, you know, there's a lot of numbers on here, but the key takeaway here is that we do have abundant U.S. stocks, and I'll show the global picture as well. But we're talking about a stock environment that's similar to 2016 to 2018, and we all know how prices were back in that time period. Again, every year is different, so we have to be careful, but we are looking at an elevated stocks set of circumstances, both on the U.S. front and also on the world front when we look at the stocks that are available. So that is going to keep a lid on our prices. And so again, when we look at what our price expectations are for old crop and new crop, the longer that we maintain these higher relative stocks relative to use, it's going to end up having adverse price effects. When we switch to soybeans real quick, we're in the process of the South American harvest right now. Soybeans are different than corn, and I want to highlight it from this map. When we look at it, there's really only three major production regions, and that's the U.S., Brazil, and Argentina. And so what happens in those three countries is imperative in terms of price direction. It's different than corn because corn, you have much more, a much bigger geographic dispersion, particularly when you look at export markets. And so what you do see in soybeans is you typically see more volatility than you do in corn, just because you've got a fewer number of countries that are producing the bulk of that crop. And so when we look at this, it's a similar set of circumstances. There's tighter U.S. stocks in soybeans than corn, but the problem is prices can only run so far from the global market. And the example that you can have on that is if prices get too expensive relative to the global market, because everything's relative, what you will see is you'll see soybeans come up from South America and be offloaded in the U.S., which will end up decreasing our prices. And so one of the key numbers that I'm looking for in terms of as we move forward in the U.S. market is how this stocks number and this exports number ends up moving, because we are probably going to end up seeing, you know, a tougher export market for soybeans just because of the global competition coming from Brazil and Argentina. When we look at global stocks, again, we're at an elevated level. A lot of that is being driven by the phenomenon down in Argentina and Brazil. When we look at this chart, we have Brazil in green, Argentina in blue. We'll see that Brazil is not projected to have as big a crop this year as last year, but it's more than made up for by Argentina as they recover from that drought. So the key takeaways for corn and soybeans is we are in a time period where we have abundant global supplies. That's going to keep a lid on prices. And then when we look at going into 2024, it's going to be a strong weather market. So that's going to be our best opportunity for pricing opportunities. So when we look at old crop prices, you know, this is one that it is challenging. We were trading, you know, up until the new year, right between that 530 and 490 level, pretty consistent. We've taken a pretty strong step down. I think we're in the process of bottoming on the futures market side of things. It's one of those ones where We've seen prices get, just below 4 back on the March contract. This is the May. But I think what we'll see now, at least until we get a little bit more information on planted acreage and weather, is kind of a sideways pattern where we'll track between that 410 to 460 range on the nearby futures. And so again, when we get to the upper end of that range, that's when if we still have corn in storage, we may want to end up considering taking the price. But I do think that our best opportunity for most parts, and again, it's challenging because the geographic areas in the state are so different in terms of basis. This is an aggregated basis, which I don't like using because by definition, basis is local. What we do have to end up counting for is the fact that we probably have a better chance of getting basis improvements in several regions than we do getting futures market improvements. And so if you do get a good basis offering on old crop corn, we may want to end up considering taking that and putting the money in our pockets. I think that's where there's a better chance of getting increased prices for crop in storage than the futures market with what we know today. When we look at soybeans, similar set of circumstances where we've seen prices come down very dramatically and move sideways. Most of this has been driven by what's been going on in South America. It's pushed prices lower. I hope we are establishing a bottom around that 1130 range, but you can't rule out another step down. It's going to depend on what happens in terms of finalizing the harvest in South America and then what happens with Chinese export demand. My hope is that what we'll end up seeing is lower prices stimulating some Chinese purchases. And so we'll have to keep an eye on that export market because that could give us a little bit of a boost or at least establish a bottom in this old crop soybean market. When we look at basis, obviously we've seen some pretty dramatic things in terms of basis due to low river levels on the Mississippi, particularly out in West Tennessee. That does kind of speak to how we might want to approach the new crop as well, because if you're worried about getting those catastrophically low basis levels at harvest and you can't store that crop, you might want to end up locking in a basis contract, even if it is negative in that 10 to 20 cent range, just to avoid the potential for 80 to $1 below that we've seen in the harvest interval the last couple of years because of low river levels. One thing, and I hesitated to put this up, but I've been getting a ton of questions as we do the winter meetings all around here. And how do you potentially improve your net selling price for a commodity that's held in storage right now? And this is again on the future side of things. It is incredibly important to note that this is a speculative position, right? This is a way to end up trying to get a few extra cents per bushel with a defined amount of risk. It's called a short option straddle. I'm using the May contract here. So there's the short time period, but you can potentially add 15 cents with a defined amount of risk. And the way to read this is you do two things simultaneously. You sell a call and you sell a put. You're collecting that 15-cent premium. Where your risk is if you get outside of this $13 and $11 range. When you look at where you start losing money, it's at $10.85 and $13.15. It's a risk, but it's a very calculated risk in terms of what your tolerance is in this market. You can add some complexity to this, but this is the basics. If you do have questions about this, you always want to make sure that you're comfortable with the risk when you're executing any type of strategy, but this is a way to collect some premium, and you can use that to augment the price that's in the bins, but this is a speculative position. When we look at new crop prices, we are definitely in a weather market. It's one of those ones where I think that's going to be our best path forward for higher prices, but we do have to keep on looking at what's happening local, regionally, and nationally. The USDA released some initial planted acreage estimates. These are still very early. I think it's going to be interesting to see what happens at the end of this month, how the producer surveys match up to their model estimates. But just in general, right now, they're projecting corn acreage down about 3.6 million to 91 million acres, soybeans up 3.9, wheat down 2.6, and cotton up 770,000. Just with what's happened in the cotton markets, I think that there's a chance that gets a little bit higher just because we've had some beneficial pricing there relative to the other commodities. When we look at our new crop pricing, I think it's really important to disaggregate those cash prices. The cash prices are the prices that are going to pay our expenses. It's going to pay our bills. I think it's really important that even if you are using a cash forward contract, right? So if you're forward contracting with an elevator or an end user, it might be beneficial to take a look. Should we end up using an HTA or a hedge to arrive and a basis contract? What it does is it allows you to get two rolls of the dice in terms of picking pricing points. And so one of the reasons for that is if you look at just from a thought process, it's very rare that you see futures and basis peak at the exact same time. And so by using two separate different pricing mechanisms, what you can do is you can lock in either a future or a basis when it's beneficial to you, because those two very rarely move in the same direction. And the reason for that is when you're looking at futures prices, they're determined in Chicago, and it's a reflection of what's going on both globally, nationally, and a whole bunch of other factors that are digested into a price. Your basis, by definition, is what's happening in terms of local supply and demand. And so those two things are usually not correlated at all. They can be, but it's usually not going to end up moving in the exact same direction. So taking two stabs at that, I think, is a pretty good strategy. When we look at drought, I mean, obviously weather's always going to play a role in our commodity markets. I pulled this as February 27th, and this is one thing that's really hammered the wheat markets. When we look at winter wheat and drought, we're estimated at 15% right now. Last year, we were at over 54%. And that's one of the things that's contributed to the decline in wheat prices. When we look at corn and soybeans, the area that I'm really focusing in on right now is this northwestern corn belt area, and seeing what's potentially going to happen up there. There's particular ramifications in terms of reallocating acreage between corn, soybeans, and wheat up there. And so I think this is where we've kind of got the action that's potentially going to happen early this season. But again, it can change very, very quickly. When we look at monthly temperature and precipitation outlook, this is 30 days. We all know that if we're trying to forecast weather more than 7 days out, our accuracy goes off a cliff. But they do put out these estimates in terms of what our average precipitation is and where we are in terms of monthly temperatures. So we're projected to be average to slightly above average in temperature, and then right around average or maybe a little bit above average in East Tennessee in terms of precipitation over the next 30 days. This is one that I think is really a good way to start looking at price expectations for 2024. I've shown this at several county meetings and at grain conferences. But what this shows is it shows the difference between nominal and real prices. The nominal price is the actual price that is shown all the way back to 1980. The average of that actual price is $2.89. That really doesn't tell you anything, because obviously we're in a completely different value environment in 2024 as compared to 1980. So when we adjust for inflation, what we get is actually an average price of $5.33 per bushel of corn on the nearby futures. And what we can really point out is we can point out high and low price environments, right? And that's really, really critical in formulating our expectations, because here we have the drought and the ethanol issue. Drought here, ethanol here. You can see that's where we had the run up in prices. We had high prices during COVID. But what ends up happening when we come off high price environments is we typically enter a lower price environment. We stay there for a while. And so we don't have to like the fact that we're entering a lower price environment, but there's two key takeaways. One, you kind of move more in a sideways trend, so there's less volatility, which we can make decisions on. And then once we end up having that, we have this usually for a sustained period. Now, weather's going to play a role in it, but it does give you an initial starting point in terms of formulating price expectations. When we look at the December contract, again, there's that weather risk premium and time premium that's embedded in that market. So trading at 461, when we're looking back to where we are in terms of the nearby, it's not a bad time to think about at least getting some downside price protection in the futures market. I wouldn't forego a ton of upside potential for that, but I'll show a strategy that you may want to end up considering in terms of looking at trying to establish a price range in the futures market. When we look at this highlights, again, if we're thinking in terms of where we're likely at in terms of supply and demand and the pricing environment moving forward, we're kind of looking to be entering into that kind of 2015 to 2020 level where we have prices, average prices, lower definitely, but lower volatility as well. And so when we think about that, you can really use options effectively in a flat or sideways trading channel because you don't have as much risk. When you're in high price environments, you have higher volatility. It increases the risk in terms of having the market move against you. So we can formulate expectations using what we've seen. Now, again, every year is different and you do have the weather risk, but at the same time, I think we can end up making some risk management decisions based on what we've seen previously. When we look at price environment, again, what this highlights, you have your price range. This is the daily December closing futures price. What it tells you is that we have a high price environment, 525 to 625 that we've been in. This goes 2009 to 2024, and a low price environment. And so if you think we're entering into a lower price environment, what this indicates is that 54% of the time, the price of the December closing futures contract closed below 450 from 2009 to 2024. When we were in a high price environment, or when we look at the higher price environment, kind of the midpoint there, 20% of the time, the December futures contract has closed above that. The challenge is I don't think we're in a high price environment anymore. I'm much more leaning towards a lower price environment. And so we think about this in terms of this risk is probably, or the likelihood of having higher prices is diminished relative to potentially having lower prices. Similar thing in soybeans. This was driven predominantly by what happened down in South America. We do have a big gap at 1240. That's going to provide significant resistance for prices increasing above that area. It's not to say that it can't go above that, but we're going to have to fill that gap if we are going to have prices go up. We have started to move sideways. Again, I put a question mark there because I'm not 100% convinced that we've bottomed out in this market. A lot of it's going to be dictated by export demand because we have pretty good estimates coming out for the Argentinian and the Brazilian crops. And so with the supply side is somewhat set until we get into our production year, what's really going to dictate that price movement is the direction of exports. We see a similar picture to the corn one where we look at a flat or lower price environment. The major difference is there is more volatility in soybeans just because we only have the 3 different countries. And so again, you can get more rapid price spikes in soybeans than corn just because of the distribution of global production to different countries. Similar price frequency table here when we're formulating price expectations. We have the high price environment and the low price environment. We have to be a little bit careful with this chart just because of some of the challenges that we've seen that really adversely affected price or kept prices muted in soybeans. And what I'm talking about is that time period. It includes the trade war with China where we had artificially low prices because of policy, not necessarily driven by market forces. So I'll close with this. I mentioned, one thing that we always want to do is we want to digest the information that's available to us and try to formulate a strategy to mitigate the risk. And so I pulled these numbers as of this morning. So December corn, when I pulled this, was trading at 459. 2 different things to end up doing. You could do just the first one, buy a 440 put option. It was trading for 24 cents. That would set a 416 futures floor. I'm not opposed to that. Getting a futures price floor that's above $4, gives you some time to end up considering. The one thing I will always say, if you set that or buy that put option, set that price floor, unless you're in the money, you should not carry it to expiration. You really want to end up looking at exiting that position and recouping the time value of the premium, usually after we enter that or when we get past the primary production risk time period, and then looking at entering a position either in the futures market or a cash contract once we get that far into the season. But carrying it until expiration when it's out of the money is just going to cost you money. Even if you can recover a few cents, it's, I think, best to end up looking at that. But looking at this, you can use it in a combination strategy, right? And so this is just a futures price fence. And so if you buy that 440 put option and you want to end up saving yourself a little bit of premium, you can sell a 560 call option for 10 cents. What the strategy does is it establishes a 440 to 560 futures price range for 14 cents. And so you have a defined amount that you're going to end up having. You'd have offsets in the cash market. So this is a hedge. And you can set that basis at any time during the production year or carry it into a later time in terms of storage if you have the ability to end up doing that.